There's certain advantages of flexible exchange rates, mainly because the government doesn't have to intervene to try and influence the exchange rate in practice. But there's some definite disadvantages of flexible exchange rates, mainly which have to do with unexpected changes in the foreign exchange market and the price of currencies. So I want to discuss this and some of the options that individuals have to try and avoid some of that risk associated with unexpected changes in the exchange rate. So to do this, let's think about, say, an American retailer who is buying British sweaters today, signing a contract today, for a delivery of UK sweaters in 6 months. And let's say it's 100 pounds, 100 million pounds, whatever. But it's deciding today for the future delivery. And the second aspect is that payment is due upon delivery. And this kind of thing happens in the international economy all the time, where people make a decision today for the delivery of something later, and they only have to pay when they actually receive the good. Now, if the current exchange rate, and I'm going to introduce for the first time a concept called spot, the spot rate, which is really the current exchange rate. Let's say that the current exchange rate is $2 per pound. So the retailer makes decisions about whether or not this is a profitable decision based on this exchange rate, this price that he or she has to pay, so that the expected cost of making this transaction is going to be $200. That's it's taking this exchange rate and that amount and converting it to dollars. So the retailer has signed this contract, waited 6 months, and let's suppose that the actual spot rate in 6 months is in fact $3 per pound. So in the meantime, between the time the contract is signed and when the transaction actually takes place, the dollar has depreciated, or equivalently, the pound is appreciated. It actually takes $3 to buy a pound rather than, say, the $2 per pound that the retailer had expected to see. So instead of facing a cost of $200, it's $300. Now this makes for a very bad day. Now, a major exchange rate swing like this is unusual in developed countries, but in developing countries, this sometimes actually takes place because of an economic crisis or whatever. So the retailer is at some disadvantage, some risk when it faces these flexible exchange rates, because the exchange rate can move in a way that is contrary to his or her economic interests. So lots of people realize this, that there is a risk associated with with movements in exchange rates. So what we have is a number of what are called hedging opportunities, hedging contracts. It's ways to try and lessen the risk associated with these flexible exchange rates. Now, these markets, these forwards markets, futures markets, options markets, which I'll discuss in some detail in a few minutes, also exist for crude oil and a lot of commodities. Actually, you can have versions of this for the stock market. So it's not unusual that these types of things, these contracts take place. But I want to focus really on one in this lecture, which is the forward market. Now, each of these has slightly different types of hedging associated with it. But the forward market means that you sign a contract today for delivery at a specific price in the future. Now I want to emphasize a couple of aspects of this. With a forward market, you sign a contract today for delivery at a specific price in the future. So you don't have to exchange any funds today. What you do is you sign a contract. So if the forward contract, and I'm going to denote that by F for forward, if the forward contract is, say, $2.20 per pound, and remember that the spot rate we had was $2 per pound. So if the retailer can sign this contract for this price, guaranteeing you'll be able to get the requisite 100 pounds, that means that in the future, he would have to come up with $220 to find the pounds required for for payment of the delivery of the sweaters. So, if the retailer thinks that the exchange rate in the future is going to be worse than, at least from his perspective, worse than $2.20 per pound, then buying the contract may make sense because it's guaranteed that price in the future. Now, who does this? Who provides these forward contracts? It's mainly commercial banks, big commercial banks offer the contract. But this is only in major currencies, ones for which there's reasonable stability. So you can get a forward contract in dollars, in euros, in pounds, in yen, a number of other major currencies. It would be very hard to get it for, say, some sub-Saharan African country currency for which there's a lot more uncertainty about what's going to happen in the future. So these hedging opportunities really are available only for the major hard currencies. Now, forward markets are not the only ones. We also have futures markets and we have options markets. Let me just say a couple of words about this. Forward markets tend to be tailor-made to the between the commercial bank and the particular person trying to get the hedging opportunity. So it's custom to the particular needs of the client. These also, I should mention this before we get any further, you can't do this for like, $50. These have got to be, very large contracts that before a commercial bank would get into this. A futures market are similar to a forward market, but they have particular end dates that everyone knows. So it's not tailor-made. There's a big market for delivery of, say, pounds on December 1st. So it's less flexible. The option, and so with both the forward and the futures market, you sign a contract that is required on both sides of the transaction. If this American retailer signs the contract for to bring dollars to the bank in 6 months, and the commercial bank has signed the contract as well, they must complete the transaction, or they could potentially be sued. So you have to complete the contract. With an options market, you buy the option to exercise the contract or not. So if it works out in your favor, then you exercise the contract if you're the retailer, and if you don't like it, then you don't. So for example, in the exchange rate example that we talked about, where the spot rate was $2 per pound and the forward rate was $2.20 per pound, if the actual exchange rate in the future, so this is the spot rate, was say $2.50 per pound, then the retailer will exercise the option, because you'd have to pay $2.50 per pound in the actual exchange market, the future spot rate, and instead could do the option of purchasing this at $2.20 if that was the option price. If the actual future spot rate turned out to be only $2 per pound, then the retailer says, I'm going to just go ahead and use the future spot rate. Now, banks know this. People operating in the futures options market know that someone may not exercise the contract, so you pay a price for that insurance policy. And you should really think about the options market as really like an insurance policy against unfavorable movements of the exchange rate. Forward market and futures market, you have to exercise. You don't really have the choice to sit back and use the spot rate of the future. So these hedging opportunities, very important in large transactions internationally with major currencies, helps mitigate some of the problems with flexible exchange rates, but it costs. The risk mitigation that's associated with these hedging opportunities does cost money, but at least it protects you from really major unfavorable moves of the exchange rate. Okay, so that's a brief view of hedging. We're going to talk about forward markets when we discuss covered interest parity, and leave the futures and options market for a different set of videos.